GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be on the show. I guess it's the last one of 2016.
Yes, I'll talk to you next year. The Canadian dollar, it's well below 74 cents now, yet the price of oil is over $53 a barrel. I thought they were supposed to go hand in hand.
They have in the past tracked pretty closely, and this is kind of unusual that there would be such a discrepancy. The oil price, as you know, from a year ago is up substantially. I think, we could say roughly from $30 to $50, rounding off. And yet the loonie is only marginally higher than it was last year at this time. So there's been quite a change there. And I think one of the big disappointments this year, certainly Bank of Canada Governor Polo's talked about this, is the lack of follow-through. Because the weaker Canadian dollar was supposed to stimulate exports outside of the energy sector, and it really hasn't happened. I did look into the exports of oil products to the United States recently, and they've been doing really well. So it should be a positive for Canada, but it hasn't shown up in the currency. And I guess one of the issues is interest rates. So interest rates are rising substantially in the U.S., and they have gone up a little bit in Canada, actually quite a bit, but not as rapidly as they have in the U.S. And I think that's probably the best explanation is the differential. So you put your money in Canadian dollars on a 5-year term, you get a 1.2% interest rate, and you put it in the U.S. and you get, say, substantially higher, closer to 2%. So that is a big gap, and that's the gap that the loonie is fighting against. And basically it's fighting a battle, and it's a losing battle, because people would rather have, maybe now with Trump being elected, they'd rather have U.S. dollars at 2% than Canadian dollars at 1.2% over the same term.
Was Bank of Canada Governor Stephen Polo's too quick to pull the trigger and cause the loonie to dip when it really didn't have to before the oil crisis?
Well, I think he was pretty concerned about the lack of growth out of Ontario and Quebec and BC in terms of the non-energy exports. So I think he was rightly concerned about the lack of growth in Canada. For instance, it's sort of hard to remember now, but last year there were 2 quarters of negative economic growth in Canada, and the growth in 2016 has not been very good either. So the outlook for 2017 isn't that great, mostly because I think Alberta is so weak. So he's probably not. He wouldn't be probably admitting that he made any mistakes. I think he's just really disappointed and surprised that the lower dollar hasn't resulted in better performance, because the U.S. economy is picking up a little bit, and that's why their interest rates are going up. So we should be following along, and we're not. That's the big puzzle in this thing.
Can he risk raising interest rates in Canada?
It's really amazing that, the possibility that our rates would start to follow the U.S. higher. It seems with the amount of debt that the household has in Canada in total, and especially with some individual households. The Bank of Canada has been talking about that recently quite loudly, about the 15 or 20% of households that have very, very high debt levels. A higher interest rate now would be just devastating for the Canadian economy, because so much of the Canadian economy is tied up in real estate and construction, and that is almost always involves a significant amount of borrowed money. So I think it would be very difficult to raise rates in Canada. So if rates don't go higher in Canada, but they they keep moving up in the United States. We're looking at the Canadian currency, the loonie, being even lower than the 73.5 cents it is right now as we speak. It went into the 60s last year, or maybe early this year. I forget exactly when, December, January. And I wouldn't be surprised to see it back there again.
Could you see at any time that Canada would adopt the U.S. dollar?
Well, it's interesting because if this had worked, if the lower dollar had worked, and we were having a strong economy now, everybody would say, "Oh, that's proof that our independent monetary policy is a good thing, and we should keep it." But the fact that it's not working now kind of throws that whole question up in the air. So the argument against it is, of course, we wouldn't have the flexibility to run an independent monetary policy, which might mean we couldn't use some of the monetary levers to help us get out of a situation like we're in now. And of course, it would mean that you wouldn't need the Bank of Canada and all that kind of stuff. But I don't see it happening anytime soon. I think the last time the loonie went down into the low 60s, which was about 15 years ago, almost now, there was talk about, first of all, they were talking about the loonie going to 50 cents, which never happened, of course, but it did go down to 62 cents. And then secondly, they were talking about pegging it to the U.S. dollar. But I don't think people would do that voluntarily. I think it would be if nothing else, it's a prestigious thing. We don't have a lot in Canada, to be proud of in terms of independence from the U.S. Our movies and everything. A lot of stuff like cars and all that are very similar. We don't really have our own Canadian car that we produce like some countries do. But we do have our currency and we have our banks. And so I think people would hang on to that for sure. Even if it wasn't really working anymore, they would still hang on to it.
Well, that sounds so typically Canadian. It doesn't work, but we'll keep it anyway.
Yeah, I mean, there's this thing about just national pride, I guess, and maybe the illusion of independence. Because with NAFTA, the amount of room for independent path in terms of trade and that sort of thing is quite limited. There's some very strong rules in NAFTA that don't allow us to go our own way in any kind of independent way. We have to keep in mind Mexico and the United States and follow the path, pretty narrow path. But the independent currency is a nice thing. Now there would be some benefits of having the same currency as the United States. There'd be some costs that would be eliminated, but they're probably not. The costs aren't that huge in terms of trading currencies and converting and all that kind of stuff.
Now, of course, too, they'd have to print more U.S. dollars, but Canada is smaller than California, so it would just be printing enough money to add a 51st state. Yeah, I mean, I think about, for instance, I was just actually reading about this in a book that was saying about Canada versus the United States, and in the Depression, the prairies were really, and there was even an Alberta social credit party that started up based on this whole theory that the main lack was lack of credit, and so they started this social credit theory, which I think originally started out of England or somewhere like that, and they blamed the Eastern bankers for not providing enough money, and that was why the farmers on Saskatchewan, Alberta were starving to death. And, whether that's correct or not, I don't know. It was one of those theories that sprung up and then eventually it kind of faded out. But imagine if we were in the U.S. dollar, we would be constantly thinking that we were being disadvantaged because the Americans were running their dollar policy for their own good and not thinking about us. There are a number of countries in the world, though, that are, like Hong Kong's pegged to the U.S. dollar. And China just sort of got off soft peg where they're struggling a bit with right now. But there have been a lot of emerging markets that have pegged their
currency to the U.S. dollar. The reason they usually do that is because otherwise they find it really hard to borrow any money. So they have to use U.S. dollars. But we're lucky so far in Canada. People will lend us money, even though we're running a trade deficit, and they'll lend it to us in Canadian dollars, which is a privilege, really.
We'll have more with Hilliard Macbeth right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Hilliard Macbeth. Hilliard, what would higher interest rates do to the Canadian real estate market? We're already seeing higher mortgage rates, even though the Bank of Canada official rate has remained the same.
I think it would be pretty difficult for we've already had a big jump. The 5-year rate has gone from 50 basis points, which was ridiculously low, to it hit 1.2% recently. It's backed off a bit to 1.15 today. And that, of course, the 5-year rate's important because that's where you get the 5-year GIC rate, and then you get the 5-year mortgage rate, which most of Canadian real estate is based on. So anything a whole lot higher than that, combined with the new CMHC rules, would create a problem where individuals have more difficulty qualifying for a mortgage. So the first-time buyer is really important, and it's what keeps the market going. That and I guess foreign money coming in. And if the first-time buyer gets blocked out of the market by higher interest rates or strict qualification rules brought in by CMHC, that's too much for the real estate market to handle, because there's always, I haven't seen too many people talking about this recently, but there used to be all this talk about baby boomers and demographics and all that in the housing market. I wrote about it, and but what has happened is the oldest baby boomers now are turning 70. It's either this year or next year, and studies show pretty strong research results that people start to sell real estate when they get to those age. Even at 65 they start, but when they get over 70 it accelerates quite rapidly. So they either die or they move in with their children, or they move to rental accommodations, seniors' homes, and that sort of thing. So there's a lot of housing that needs to get absorbed because the baby boomers are very large in quantity. And so in order to keep that those houses that are coming free as a result of demographics, you need more and more first-time buyers to come along. And so the first-time buyer is very sensitive to the interest rate. A friend of mine in Alberta here a few years ago told me, even back when things were a lot easier, when the economy was a lot stronger, he said every young couple that comes in, they barely qualify for the homes that they're trying to sell them. So any kind of a change in that, even a few ticks on the interest rate, is going to have a big impact. And of course, that's probably why the BC government has introduced this new help with the down payment loan, the interest-free loan that they're talking about. It's kind of hilarious because CMHC is openly talking about going completely the other direction and making it more difficult for people with almost no down payment to jump into the market. And then the BC government recently comes out with this new program where they're going to make it easier for people to buy really expensive real estate, even if they can't afford it.
Yeah, so we do have this contradiction in government policy then. But it was also Christie who introduced the 15% foreign buyer tax for the Greater Vancouver area in the hopes of bringing prices down. Well, prices have plummeted. And now she's going to add $37,500 to, I think, the price of a house, because that'll be written in. And if you calculate a 7% commission on $37,000, that's a $2,600 gift to real estate agents, isn't it?
Well, I think the bigger, that's right, but the bigger gift is coming up with a new source of buyers, because that's the problem. When prices start to come down, it's great. Things are more affordable. But if the buyers all disappear because they're priced out of the market, or they can't, even with the lower prices, they can't jump in, then the market starts to correct, and it could even develop into a crash because, as greedy as people get when prices keep rising and they feel like they have to jump in now, or they're never going to be able to get in, it can switch in a heartbeat to a situation where they see prices dropping, and they say, well, gee, if I wait 6 months, maybe I'll get another $100,000 off of that price. But I think that the 15% foreign buyer's tax is targeting the more expensive homes, because most of that foreign buying was at the higher end, and the help with the down payment up to $37,500 is basically targeted at the first-time buyer. But my sense is, and I think studies back this up, although I can't think of a specific study right now, but certainly the CMHC had Evan Sudall mentioned this in a recent speech he gave in England, that the only impact of these help with down payments and that sort of thing is to push prices higher. So the first-time buyer isn't any better off, because they're, as you just said a minute ago, they get $37,500 interest-free loan for 5 years, but the price of the house goes up by $37,500. They're no further ahead. In fact, they're worse off because now they've got more debt than they would have had. It would have been much better, in my opinion, to just let the houses prices come down until people could genuinely afford them, without gimmicks and special deals like this. But I think any government that is trying to get reelected during a period when house prices are dropping is probably going to have a difficult time getting reelected. That's probably what the government is concerned about more than anything. And they may not be thinking about the longer term at all. They may be just thinking about the next 6 months or so till the election.
May 9th. Well, the government didn't hesitate to put new ads out every 10 seconds on TV. The BC government is now making it easier to buy a house. Really? They're using my tax money. I mean, this is pretty typical for any government, to use your own tax money to buy votes. But I didn't sign up to help somebody else buy a house. Where was the government when I was trying to buy one?
Yeah, and you wonder if you're actually doing them a favor, because really, if prices are dropping, and that's certainly the thesis of my book, is that they will drop quite a bit. They would be better off just to stay in the rental for another year or even 2 years, and they'll get a much better deal. And because that $37,500, they still have to pay that back at some point. It's just interest free for the first, I think, 5 years or something like that. But it's still debt that they are going to be responsible for. And I think that's what's sort of wrong with this whole equation that we're in right now in Canada is people have forgotten about the way that debt stays with you for a long time. Like it's just hard to put into words the difficulty of a $300,000 or $400,000 or $500,000 debt, and the burden that creates for a young family just starting out. It's just it can take the rest of their lives to pay it off. And I know that, having talked to some people, because I was really puzzled by this. And then I realized after a while, talking to a number of people, that they're not really thinking about paying back, because if interest rates went back up to 6%, for example, you would double the amount. So if the loan's $500,000, I think it's 6.5% or somewhere in there, you actually pay another $500,000 in interest over a 25-year average. So they're really signing up for $1 million repayment, and that that's what, $25,000 a year over 40 years. That's just too much. And what I've discovered was that people don't think about it that way. They think about it in terms of getting that home, and then the home will go up in value, and then they'll sell it, right? And they'll make a profit. It's not about paying back that loan. So everybody's thinking the same thing. They're going to get this home. The question is, who are they going to sell it to? Because going back to where we started a minute ago, was the baby boomers are turning 70. The oldest baby boomers are turning 70. The youngest baby boomers are still 55, but the oldest baby boomers are turning 70, and they're going to be sellers. They're not going to be buyers anymore. So it's I don't know who these all these people that are buying these houses with very large debts are going to be able to sell their homes too for a profit. And then the other problem with that theory, it's got a really big hole in it, and that is that if the prices go up so that you can make a profit selling your home that you bought with all the debt, you still have to live somewhere, right? So there isn't going to be anything else that's going to magically be cheaper. So you would have to move to a trailer or something like that in order to take advantage of that, or maybe move into a rental place. But you just don't see that happening very often.
Would you describe the $37,000 as a bigger piece of cheese in the debt trap?
I think it's definitely what would you call it? It's luring. Yeah, it's a lure into the trap for sure. And but that isn't the only thing. And there's advertising everywhere. It's unbelievable how much pressure there is on the young people. Not just from advertising, not just from government programs, but from parents and peers, everybody telling them, "Oh, you've got to get in now, because if you don't get in now, it's like you'll never get in. Or if you don't get in now, your life can't begin until you get in." I had people say, "Well, what if we want to start a family?" Well, you can't. The feeling is that you can't start a family until you buy a house. And of course, none of that's true. It's you can easily raise a family, at least for the first few years, in rental space. But there's that. This has become so strong and so widely held that everybody's coming to believe that the first thing you have to do before your life can start is to buy a home. But I wish somebody somewhere along the way would point out that these people are signing up for a very long and difficult period of paying debt back, and and that means giving up all kinds of stuff like vacations and restaurant meals and fun stuff. That I think people could come to resent a home that represented such a big burden after a while.
As they say, house rich, cash poor.
Exactly. That's exactly right. And heaven forbid that prices don't rise, because as long as prices were going up, I think people would put up with it, even though they might grumble a little bit about that monthly payment. But imagine if prices were going down or just sideways, that monthly payment would loom very large in that scenario, where people would feel they could easily get quite discouraged. Because what if, I just had this the other day, a client said they were going to give their kids some money to buy a house. And the thought came to my mind that, what if the job market isn't that great in Alberta right now? What if they get an offer of a job in Toronto or Montreal? Now they're stuck with this house that they feel obligated to stick with. And, there's some advantages to being a little bit more flexible, especially in a difficult job market like Canada's in right now. And being able to move could be a big benefit. And if you buy a house and then you have to sell it and you can't sell it, then, it's a big commitment. You have to be sure where it is that you want to live before you take that big step in the kind of real estate market that I think we're going to, where it's going to be harder to buy and sell.
Well, Toronto and Vancouver are the exceptions to the rule, but Vancouver prices for houses have dropped nearly 30% since the start of the year. And what kind of price drops have you seen in Calgary and Edmonton?
We haven't seen, in the official numbers, we haven't seen those kind of drops yet. It's more like 5 to 10%. And yet, I think at the higher end, the price drops are probably more like the 30% that you're talking about. But in Calgary and Edmonton, the number of expensive homes is smaller than it is in Vancouver. So if you look at the index numbers, they don't show that kind of a drop. But I know anecdotally from talking to people that did have a $2 million home that the drops are pretty substantial. I mean, first of all, never mind price drop, it's just impossible to sell them sometimes. There's just no market. I mean, it's hard to believe, because we got so caught up in this bubble, but there really aren't that many people in all of society that can afford a $2 million house. It's like, what kind of income do you need for that? Maybe a $500,000 annual income? Well, that's way beyond the 1% threshold. Even in Calgary, a $500,000 income is quite rare, although it's not as rare as it is in Edmonton or Vancouver, but it's still pretty rare. And it's becoming even more rare since people are losing their jobs. So, I mean, there just aren't enough people that can afford houses in that price range. And the other thing is the few people that can afford house prices like that, they already own a home. So they don't need two homes. So they'd have to sell their expensive home to buy the other expensive home, and that's where the problems really get difficult because it's very expensive to sell and buy $2 million homes. So I would think the price drops have been that large, but sometimes there's just so few transactions that you don't get a clear sense of what the prices really are, because a lot of times people will just pull the house off the market if they've got a $2 million house and they can't sell it without dropping the price to $1 million. They might just say, well, I'm not doing that. I'm not willing to drop it that low, so I'm just going to take it off the market. And I suspect there's a lot of that going on right now.
Hilliard, have yourself a very happy new year.
Same to you, and we'll talk to you again in 2017.
My guest has been Hilliard Macbeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. Happy New Year.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.